Hello and welcome to the Harwood Report for November 27th, 2018. I am Keith Harwood, the founder of Trade Academy and the host of the Harwood Report. As a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of these disclosures before I get into the charts. Alrighty. It's been an interesting kind of couple weeks here, obviously. We just had the Thanksgiving holiday. We're out of that now. Now we're moving forward to thinking about the next holiday, frankly. That's what happens as we get into November and December. People start getting a little bit tired of the market. A lot of tax loss selling probably already hit the market. People don't necessarily want to position too big short going into the holidays. It just never seems to work out unless some sort of news comes out. So right now we're truly in that feed the bear market, in my opinion, and that's part of why today's sell-off kind of reversed relatively quickly because it wasn't real news. We'll talk about gold because that's actually a really big shift in the last couple days, and then of course we got to talk about oil because oil has just been trending lower. And where's the bottom? Is it $50 oil or are we going to $40 oil? Are we going right back up to $80 oil? So let's take a look at all these charts and kind of see if we can get a grasp on what's going to happen next. First things first, fear and greed's at 18. This is a very extreme low. So, I've been kind of advocating for this concept of a similarity to what happened in February where we had a break, small bounce break, bigger bounce break, and then recovery. So we had the break, small bounce break, bigger bounce break, and now we should be in that recovery mode. And the action that we're seeing on days like today, where a down day, quote unquote, isn't necessarily that bearish, I think kind of goes hand in hand with that. When we actually look at the indicators, this is garbage. It doesn't mean anything. The fact that stocks and bonds over the last 20 days are basically both unchanged means nothing. That's not greedy. That's just nothing. But as we go through the other ones, we can start to see them coming away from extreme fear. The new 52-week highs and lows, you see that kind of shifting back around. One of the things I had talked about with this was that this kind of looked like the mirror image of what happened in December and January, where everything got so bullish that it was natural for us to come the other way. This time we got so bearish that it seems natural for us to come the other way. So we're going to be looking for stocks that are going to make new 52-week highs into year end. This also naturally happens as we're going into year end. People don't necessarily sell their big winners into year end for tax reasons, right? So those stocks that have performed well have a motivation to continue to perform well. There's a less natural seller because people don't want to pay that tax bill in April on these stocks. They'd rather see if they can defer that tax bill another year. So you hold on to your winners, you sell them in January instead of in December, and bam, now you've got a 1 year reprieve on paying the taxes on that profit. So something that we also have to keep in mind as we go into year end. This is kind of what helps drag some of that, that holiday market grind higher mode. The natural seller starts to disappear because they don't sell into rallies. They were looking to sell their losers, which we had a lot of them in October and November for people to sell. And I tend to believe that type of selling, the tax-driven selling, should be fairly wrapped up here. Especially when I start seeing stuff like this. Put-call ratio stuff, it's still at the highs, so that's just people still looking to hedge rather than exit into rallies. That's another indicator to me that people aren't necessarily selling out their winners on rallies. They might be looking to just buy puts in the rallies so that they're protected into the year end rather than out and paying the tax bill again. And then the stock price breadth has been bad. Let's see if that turns around. Of course, junk bond demand that's not an indicator that matters really much. And then this extreme fear. If we're going to get this away from extreme fear, we need to be pressing back towards 2750, 2800. That's a big ways away here in the S&P. So just keeping all that stuff in mind. If we are going to get back into the midpoints here, I think we're looking at a $10 rally in SPY. So let's look at SPY. What am I looking at? Move backward here towards 275, which is pretty close to 2750 in the big index. That's a big recovery. What has to happen first is we actually have to close above the 10-day moving average. So that's the first little hurdle. The second hurdle, of course, is the 20. The third hurdle is the 200. The 50 and the 100 are above the 200 still. Okay? But the short-term trend signal people are looking at the 10 and the 20-day moving average. The long-term tend to look at the 200. I don't think there's going to be a huge amount of resistance here at the 10 and the 20-day moving average. I think we're more likely to see resistance in chop once we get to the 200-day moving average because that is such a big long-term trend following system signal. The bears are going to be looking to fight that one. They don't want the close above the 200-day moving average, and the bulls, of course, are going to be wanting to fight above it. So that creates some consolidation there as there's a battleground that occurs. To get there, what's the trade? For me, probably more of a butterfly. I talked about the specifics in the newsletter I published yesterday for our premium subscribers. If you're interested, you take a look at that, and you'll start to see kind of where the value add is, where I actually combine these technical indicators with some of the option stuff. Because one of the big things that you got to look at when you're doing that rally is if that happens, the VIX is going to drop probably back down here towards 16. So if we get the VIX down to 16, maybe even lower because it's holiday markets and people start to say, okay, well, that was it. Holidays are going to get slow. Might as well press the VIX even lower. That's how you then look to structure that trade. And how I look to structure the trade is basically what volatility is going to do in the process of the move and at the end of the move. When I look at tech, obviously it's been driven down by Apple. Apple has had a really rough run. Now, tech tried to close above the 10-day moving average today. Apple is continuing to be weak because of Trump tweets. But it actually isn't all that bad. Yes, it's down today, but it has recovered from lows. And, of course, the big one for me is SMH. And SMH is showing relative strength. It's above the 10-day moving average and approaching the 20-day moving average. We start seeing some momentum there. That starts to give us maybe early indications that tech is oversold and needs that full bounce. SMH had been weak relative to tech before the break. Now it's showing strength relative to tech. That's a bullish indicator to me. Another thing that had been showing weakness at the beginning of this break was IWM. It was relatively weak. Now, IWM today is slightly under the 10-day moving average, but yesterday it closed above. So keep in mind that IWM now is the first of those three, SPY, QQQ, and IWM, big boys, to be above the 10-day moving average, albeit it's a little questionable today. This all kind of leads to everything I'm talking about here with that, if we're going into a holiday market, we drive the VIX lower. We're seeing some early indicators of potential for bounce that may even turn to a bullish behavior. Of course, we're waiting to find out what happens when Trump and Xi sit down and talk about trade. That can move everything and change the whole landscape like that. So we don't necessarily expect the technicals to, pun intended, trump the fundamentals if there's a real fundamental update. If there is no update off of that trade thing, that's slightly bearish. If there's minor updates, that's very neutral, and then the technicals go back into control. I go to TLT now, so because we got to sneak buy bonds, and it's really going to be something I sneak buy. Because I think that this is a kind of a range trade. 113.5, 115.5, maybe a little tighter, 114 to 115, because nothing's really changing in terms of bond yield requirements here. We haven't gotten low enough in the stock market to really, really greatly reduce our rate hike expectations. We haven't recovered enough to firm them back to the potential of this new low in TLT. So if the market can recover enough, maybe we can increase bond yields and push TLT back down to the lows. If the market collapses, TLT should continue to firm, maybe back into that 117, 118 range. But in the meanwhile, all of this is, to me, a spot where bond yields are a laggard to stock price movement, and stock price movement right now isn't at either level that indicates bond yields have to move drastically. We're not making new lows and pressing lower and looking like a real recession, and we're not rallying to the point where we can start saying that everything from October's sell-off is in the rearview mirror. So right now, lack of clarity in stocks leads to, I think, lack of movement in bonds. So let's go to something that's a little more interesting, and that would be gold. So we'll start with the dollar index. Look at that, looking like it wants to make a new high. Everybody knows my favorite is dollar yen. Look at that, looking like it wants to break out above at least the early November highs, and then we'll see if it can press through the early October highs. And if all of that happens, that's not good for gold. And yesterday I was talking about some structures on the bearish side in gold. We've already gotten a bit of the break. We're down to 114.68. I'm looking for a little bit more down here through 114, maybe even down to 113.5. Get into this consolidation area that we had for September. That's really how we're looking to play that. It's similar to what I've talked about in S&Ps and some of these others. It's looking for a bit bit of downside, but not a drastic downside. There's still tends to be some buyers right now in gold trying to figure out ways to hedge portfolio risk and thinking that gold is a great portfolio hedge. It's not a great portfolio hedge. It's an uncorrelated asset that, right now it's got a little bit of risk off, risk on behavior to it, but it's not huge. It's just mostly a currency play, it seems like. If things go well with China, gold may rally with the stock market. If things go poorly with China, gold may sell off with the stock market. We don't know yet because we don't see the 100% the currency and the bond reactions and everything else. We just got to wait for our signals. Right now, the dollar is strong, and so gold is falling. Okay? That's bad for silver, obviously, as well as the gold miners. The one thing I will say, and I've kind of talked about this before, but I'm still an advocate of this, is that the gold miners are weak, but I don't really want to touch these because gold miners are derivative of the gold market, and the gold market has been more in a chop. On top of that, gold miner volatility is high, so it makes it a little bit tougher to trade the options on that, knowing that it is, for me, I'm deriving my gold action off of a different signal. So I don't want to derive my action in the price miners off of a signal that's generated off of a different signal when volatility is not cheap. If volatility were cheap, then I can kind of play that secondary derivative type element. But right now, for me, gold miners are they're kind of a no trade. I go over to oil now. So let's start with USO because everybody wants to look at oil prices, which have just gotten destroyed. And you can see they're getting hit again today. So oil, it needs to find some sort of flooring here at some point. And I wouldn't be surprised if it found that flooring off the G20 meeting. So something happens with Trump and China. Something happens with one of the other oil-producing countries. Something, it's in Buenos Aires. Maybe we talk enough about stuff with some of the South American producers, or we start talking to anybody else that is going to have a potential impact that creates global demand for global growth. So the G20 meeting, I think, is going to be a big potential helper for oil. And the biggest help, of course, would be if things got better with China trade. In the meanwhile, we look at XLE and we say, okay, it hasn't collapsed, but it did kind of lead the sell-off, and it's really, not doing so hot. We look at OIH and we say, that's even worse. And the play to me is not built upon trying to ride the short in these equities anymore, because if I'm starting to get a little bit bullish on equities, looking for a bounce back, I don't want to necessarily have conflicting signals on the XLE and OIH, because if the market is buying equities but selling oil still, then that creates, a tailwind in the form of index buyers and a headwind in the form of oil sellers. So it's not enough to generate a great trade. Now, if I start to see things flip in oil where oil prices start to rally, I want to go to OIH and XLE. People will likely go to the big cap stuff first, your ExxonMobils, your Chevrons, your BPs, and look for those plays. But OIH is where the real leverage is if that occurs. Right now, leverage is not cheap. It needs to get cheaper. It gets cheaper if we get a little bit of a bounce. And then we can start looking for those plays. There are little plays I can play right now in OIH, looking for a move back here off of a dead cat bounce. Just to get, but that gets us above the 10 and the 20-day moving average, and then we start to see some vol sellers, I think, into that rally. So similar to what I was talking about in the S&Ps, I think you could see volatility really get hit here if USO bounces enough to generate some bounce back in OIH and XLE. But it's USO that seems to be the signal, and right now USO just can't seem to find its footing. So we got to figure out what's going to cause that to find its footing. Maybe simply equities bouncing back starts to put some more strength into the global growth story. Maybe it's something with the G20. Maybe it's honestly just this week's oil number. If this week's oil number shows different differences from expectations, instead of having bigger builds than expected and starts doing smaller builds or draws that are bigger than expected depending on the product, the distillate and the heating oil stuff, then maybe we can start to turn around. But until then, I think we just wait for the signal to cross and then look for a pouncing opportunity in OIH and XLE. All right, folks, that was a lot of stuff there. If you want more, you can sign up for the Harwood Report. You get a lot of the stuff I just covered right now in the newsletter that I posted yesterday. So it gets concepts, starts talking through trading, specific trade concepts that apply to these technical analysis. So I take the technical analysis, I pair it with volatility analysis, and I walk through a few trade ideas. I then give another update in the middle of the week. It's a secondary video so that, as the technicals and the volatility levels shift, you get more information again. So I gave a lot away for today talking about a lot of these technicals. If you want more, sign up now. You get the first week for free, which is a good price. And then after that, it's only $49 a month, which is also a good price. So you get a lot of value for $49 a month. Go to tradeacademy.co/Harwood Report to sign up. And feel free to email me, keith@tradeacademy.co, or call me 312-600-8004 if you have any comments. Thanks again, folks. Have a wonderful rest of your week.